Let's welcome in Kristina Hooper, Chief Global Market Strategist of Invesco. Kristina, I'm glad you're on with us today. We have so much to digest from, we got a jobs number last week, surprised everybody, a retail sales number, really also quite great month over month, and what we're hearing from Jay Powell. So much to take in. And, the concern is whether we can recover and or are we running too fast in certain areas that we actually have asset bubbles to the point that it's almost like a Ponzi scheme. I mean, what's your thought when you're looking at what's going on here?
Well, what I see is an almost complete decoupling of the stock market from the economy. And that really has been taking place since late March. And we shouldn't be too surprised, given that this is following a similar storyline that we saw in the global financial crisis, where the Fed steps in, it provides extraordinary monetary policy support, and that creates a put under stocks. Last time it was a Bernanke put, this time it's a Powell put. And it's a lot bigger and it's a lot more cushiony. And so it creates a real upward bias for stocks and other risk assets. Because keep in mind, the Fed has been far more activist this time around, and it's focused on other areas of the market, like supporting credit. So this is an extraordinary time to be in the market, but we shouldn't be surprised to see what we're seeing in risk assets.
I like that you said that. And the phrase when I said asset bubbles and concern, it's almost like a Ponzi scheme when everybody just runs in. I mean, some of these stocks that are up 100 or 200%. It was from an article I was reading today. I don't necessarily feel that way. I think that you pick and choose what it is that you want to invest in. That being said, you mentioned what's going on, and decoupling was the word you used for what we're seeing in the market and the economy. But doesn't the market lead? Right? Lead, because I hear a lot of people, money managers, saying, well, in 2021, this company should have this earnings, right? Isn't the market more forward-looking by nature?
The market is definitely more forward-looking, but what the Fed has done is it has enabled the market to look ahead 3 or 4 years when it normally looks ahead 6 to 12 months. The reality is that it is very hard to look ahead 6 to 12 months. We have more than 1 in 3 S&P 500 companies that have decided to dispense with earnings guidance this year. So it is actually very, very hard to maintain that kind of short-term focus. So markets are looking long-term and recognizing the incredible power of the Fed.
Yeah, I wonder if because the Fed is providing so much backing in every way, right, really using monetary policy and stimulus to make everything work the way it's supposed to. I know even today, Jay Powell said employment is such a key part of economic recovery, and to get back to folks having jobs. He said he can't get back to February numbers, but to get folks back to the jobs. The question is, if the Fed can keep doing this, and for how long? I mean, they basically said they're going to keep everything the same for some time, right?
Yes, I mean, clearly the Fed can keep doing this. What was really interesting is something Jay Powell said in his press conference last week. He talked about nonprofits and how they're trying to somehow fit nonprofits into a current lending facility or even create a new one. This is a Fed that is incredibly sensitive to the needs of the U.S. economy and recognizes that some of the mistakes that the Fed made post-GFC was to create tools that only impacted capital markets. So even though it's quite difficult for the Fed to impact the general economy that much, this Fed is really earning its pay trying to do just that.
You're the chief market strategist, global market strategist. It almost seems too easy, doesn't it? With everything set up the way it is from the Fed, even a bad headline just knocks the market down for one day and it comes back. I mean, do you say to everybody, don't sit on the sidelines, like put something in, get in there?
Well, the greatest mistake we learned from the global financial crisis was to abandon stocks and sit on the sidelines and really lock in losses and miss out on capital appreciation opportunities. So that is certainly an important cautionary tale. But what we encourage clients to do is take a long-term perspective. That means being very well diversified, but having adequate exposure to risk assets. And of course, the Fed is helping this scenario along right now.
Yeah. Great to see you. Thank you so much. Kristina Hooper, Chief Global Market Strategist, Invesco. Thank you.